It's time for Ask Mike Mondays. Mike answers one listener's question every week. Here's Michael Becker and Paul Peebles.
Welcome to Ask Mike Mondays. I'm your host, Paul Peebles, National Underwriter for Old Capital Lending here in Texas. With me today, the guy who owns more real estate than anybody that I know here in the great state of Texas, the operator himself, Mr. Michael Becker. Michael, how are you?
Paul, doing pretty good today. How are you?
I'm doing great. You guys over at SPI just keep knocking out of the park. When does this golden road ever end? I mean,
seemingly goes on forever, but I'm sure at some point we'll hit a little bump in the road. We hit one, 15, 16 months ago, and kind of smoothed right over that one. So I'm sure there'll be something else around the corner and in a couple of years, but the next, three or so years, kind of the intermediate term, look pretty smooth sailing with, good operations, ton of investment demand. So I think it's kind of the golden age of multifamily ownership. It just kind of continues going on.
Well, we're going to come back to that bump in the road because I think that's important, but super excited to announce again, if you didn't hear it last week, it is definitely worth going to. If you are an apartment owner, apartment investor, an apartment sponsor, or just somebody seeking information how not to get screwed in multifamily investing, so to speak, go to the Old Capital Conference. Old Capital Conference. This is the national conference that Old Capital has every year. This is a long-running conference for apartment investors, and it's going to be, again, in Dallas, Texas, specifically at Texas Rangers Ballpark, Globe Life Field in Arlington, Texas, September 22nd and 23rd. This, Michael, we are going to be on the field, right where the Texas Rangers play the New York Yankees, where they play the Boston Red Sox, they play the Marlins. We're going to be on the grass. In fact, after we have the conference, we have our great keynote speaker, which we won't announce for another month or so. I think we're going to play a baseball game with the bases and everything on the field after the conference. And so you'll bring out the wiffle ball and the wiffle bat, and we'll hit the ball around on the field to get some excitement. But again, the Old Capital Conference is the premier event in multifamily investing. You want to go to oldcapitalconference.com, oldcapitalconference.com to get your ticket. It is, I think right now, after July something, maybe prices are going to go up, but you still have the ability to get some great pricing to come to Texas and learn from the best. Michael, any words of wisdom for folks that need to see or come to see maybe you at the conference, meet you?
I'll be there, right? Yeah, no, excited. It's always a good event. Where last time we did the House of Blues had 700 or so. Your closest friends were there from all over the country, so it was great event, great networking the night before, and then kind of the night after, everyone tends to go to dinner and do something or another. So it's a great event, and good speakers. Some of the top typically host the listing brokers panel. So we have a bunch of the top players all across the state will be here, kind of covering all. It's not just Dallas-Fort Worth, but it's all the major metros here. So if you guys are interested in learning about multifamily or networking, and specifically if you guys want to own property or invest in property in the four majors in Texas, where we should have a pretty good representation on the panel that I'm doing, plus a bunch of lenders. And not sure what else you and James have in store for the rest of this conference. I know James does all the work, and I just kind of show up, and you do somewhere in between. But it's should be a good event as always, and looking forward to more and more in-person events. It's been too long.
I think what we're going to do is something similar to how we've done the last couple of years, the rocking chair panel. A lot of people that got into multifamily in the last 3 or 4 years, I call those kind of newbies. They just don't have a history of what multifamily ownership or experience or brokerage is all about. And so we bring in some of the people that have a little gray or white on their temples that can talk a little bit about what they've seen in the last 30 or 35 years. Something about coming over to talk with Grandpa and say, Grandpa, what did you do? 25 or 30 years ago. I think this is a great time to people to learn about the history of multifamily and, do things repeat or do they rhyme when it comes to cycles? And so, was the recession, how did that impact multifamily? How did the 87 tax law change? How did that impact multifamily? a lot of people don't know those stories. And so, we'll see if we can break down some of these stories for you to listen and get a better understanding about some of the history of multifamily. So if you see a problem coming up that you see sounds familiar, how it was maybe 20 years ago, that you can react to it. So you have some great seniors in the multifamily space coming to teach you. So, this is, again, a little bit of a potpourri. We're going to be talking we talked about a little bit of bump in the road. And we can't get to the bump in the road until we say, Michael, what questions do you ask when you're buying apartments? So, Michael, when you're, whether you're a brand new person getting into multifamily, and you may not be part of a mentor or sponsor group that has a history, or you may have not been a limited partner, being close to somebody that's actually asking the right questions, and you're just kind of a fly on the wall, and now you want to become the guy who's in charge. You want to be the captain of the airplane now. What questions, let's say, did you ask when you first got into multifamily that you thought were good? And then we'll talk a little bit about those bumps in the road.
Well, we come up from several different angles, Paul. You got to find deals, you got to find money, and that's kind of how you get your deal awarded to you. And then, so you got to be able to, source it for the brokers, as we talked about before, and, then, work with passive investors, raise the capital, and then you got to be able to get your loan. But maybe some of the stuff we can talk about here, just some of the things we do when we're trying to determine if this is the deal, or just, that we should, go after, or something that we'll pass on. This part of that's kind of like your financial metrics. So, kind of basically, does this thing meet kind of the minimum returns? So, I'm kind of thinking about it when I'm looking at these deals, I have kind of my criteria, which is evolved over the years, where we're buying, nicer, bigger, better stuff than when we started. But, does this kind of fit the basic criteria? Is this in the price range that I feel comfortable I can raise capital for? And what are my investors looking for from like a return metric? So if I gotta produce 13% IRR and a certain cash on cash, if I can't, after my compensation, with a reasonable underwriting, project that I can hit those returns, and I might love this deal, but if I can't hit those returns, there's nothing I can do about it, and I need to pass on that deal and kind of focus for the next one. So that's kind of one part of it. So it's kind of probing, kind of what are the rental rate comps, and what are some of my value add plans if we're doing a value add that I can spend money. What does that cost? And then the other parts, once you kind of underwrite it, when you actually get awarded the deal, when you're kind of in diligence, what are some of the things that you need to do to kind of verify that? So, the questions that I ask, Paul, really is kind of on properties, trying to make sure I understand what the comps are. So here's my property. What are the top, 3, 4, 5 comps that are kind of the most relevant, and what are they getting? And let's go investigate those comps and see, my property is tired and needs to be updated, and the ones down the street is getting, $100, $150 more in rent, but it's, nicely renovated. In theory, we should be able to, spend X amount of dollars to renovate my property, make it look like the one down the street, and then raise the rents to there. Once you get into it, what did you budget for on the front end on deferred maintenance? And then, when you're doing an inspection, is there anything that is kind of a surprise, right? So, you should have eyes and certain level of experience. So you should be able to see that, if the paint's all faded and there's a bunch of carpentry issues and the parking lot's got potholes, you should understand that. But, I guess if the underground plumbing is all messed up and the boiler system's bad and there's some electrical issues or something that's unknown that you discovered during the inspection period, you need to, make sure that you have that accounted for in your budget. And if that doesn't work, then maybe, the deals, you should pass on the deal or work on getting some sort of price adjustment. But if, I think just be careful, because today's environment is pretty difficult. The investment sales brokers, have a lot of options today where they maybe they didn't 10 years ago. So there's always the next group behind you. So, doing as much investigation up front and really asking questions to try to see what is my capital budget really need to be for this particular asset? Because that's something that I think kind of blows some of these deals up. And what are the comps? And make sure I get my rent comps there, and talking with the management company to make sure that, hey, I'm budgeting X amount for payroll and R&M and admin and all these various expense line items, and is that am I aggressive, too conservative? What's the right number? So talking to the management company, trying to shore this up, and now we've done so many of these calls, we're pretty close, so we don't really need to ask a bunch of questions, because we know what the right answer is on stuff like that. But when you start out, that's really something that you want to make sure you get a second opinion on, and we always get a second opinion on it before we go past the point of no return. We always make sure that our budget's in line with the management company's budget, or we adjust accordingly along the way. So those are certainly some of the things that come to mind, Paul.
What comes first? Is it you doing your budget or having the management company do the budget? And the reason why I ask that question is that some people who may not be familiar with why we do budgets, we kind of call them pro formas, because if I give you the keys, today, how are you going to operate the property in the future? What's your new taxes going to be? What's your insurance going to be? So my question is that do you guys do the pro forma first, or do you send it over to your management company and let them do the pro forma and see if that makes sense to you?
Yeah, you definitely need to get yourself in a position where you can do the pro forma on your own, because you can't rely on the management company, because they're busy doing, managing properties, right? They don't have time to underwrite every deal under the sun for you. And if you do that, you're going to wear your vendor out. They're not going to take your phone calls anymore. If you're looking at 50 deals and you get 50 budgets and you don't buy any of them, eventually they're wasting their time. They're not going to spend time on it. So you need to be able to get yourself in a position to, understand what, a Class C multifamily in suburban Texas, what does R&M look like? What does payroll look like? And, get some swag or kind of rule of thumb numbers on a per door basis. And then, insurance, you should have kind of a swag number to start. But I mean, that's something that you call your insurance agent for. And taxes, typically people are underwriting, anywhere from 85 to 95% of the purchase price times the millage rate. That's kind of like your adjusted tax number, somewhere in that range. And, but before we go past the point of no return, we'll call the tax consultant and, say, hey, this is what we're budgeting. Do you concur? Do you not concur? And get a second opinion. And then, once we kind of get, pretty close to getting awarded the deal or got awarded the deal, that's when we go to the management company, Paul, and say, okay, hey, I'm in the best and final. Hey, this is mine. Can you review and at least give me some high level feedback? Am I off on any major category? At least get some level of feedback from the management company.
And at what period of time do you bring the lender in? Do you bring them in at the beginning when looking through the deal? Do you bring them in at best and final? Do you bring them in after you've been awarded the deal? After closing 40 some plus transactions and being a former banker, where do you typically bring the bank in if you're maybe a newbie in this deal?
Yeah, pretty early on. I think that's something that you guys do all the time, especially if it's a marketed deal. You're likely going to see that marketed deal with you or one of the guys at Old Capital will see pretty much all those deals. And, it's easy to kind of go through and, you'll get the what you asked for, Paul. I'm assuming when someone comes to you and asks you for a debt quote, you're going to ask for a T12 or rent roll, capital budget, and operating kind of pro forma. And then you're going to go through that. And then you're going to put your banker's hat on and say, okay, the lender's not going to, you're underwriting 900 in payroll and that's not market, right? So you guys are going to push that up. And I think your lender's kind of a little gut check along the way as well, at least get some sort of initial feedback. Obviously, I don't think you want to go get a full-blown loan quote on every little deal that you're looking at, right? And until you get a little bit closer and kind of maybe make the best and final. So you just want to be respectful of all your various vendors' time, like your mortgage broker and your management company and people like that. You don't want to be the boy that cried wolf all over and over again, just wasting everyone's time. But I think once you start getting, a little bit of traction, pretty serious, you got a reasonable shot of winning the deal. I think that's when you bring in all these people. But you definitely want to get a loan quote before you, go with your final offer at minimum. You don't want to get the thing tied up and then not realize what, expecting to get, 80% leverage and you can only get 70 and your pro forma is blown, your returns are blown. You certainly want to know that before you get to that point.
Put your brand new buyer hat on. You've just got into multifamily and you're looking to buy stuff and you're looking for inventory all across the nation. Just one thing, would you look all over the nation for all these different markets, or would you try to concentrate on one or two markets?
Yeah, I think that's certainly something you want to focus on, one or two markets really, Paul. I would think that, depending on your criteria, we want to focus on the larger MSAs. Like I wouldn't buy a property in an MSA less than 1 million people if I'm starting out, right? You want to get in a place that's got a lot of inventory, so it kind of increases your odds of actually getting something done. Because if you're in Wichita, Kansas, there's only so many properties in Wichita, Kansas, so it's hard to. You're not saying you can't find a deal there, but you're just not gonna have the same level of opportunity. So kind of find that market or two and really kind of focus on those and get a little bit of traction there. And then once you buy a deal, then you can then leverage that successful transaction to try to get some more transactions in that marketplace, because it's all academic and no one believes you can do it until you actually do it. And then once you do it, then the world kind of opens up for you, and the second or third transaction in that market are materially easier because you actually proof of concept that you can buy a deal, and the brokers will take it a lot more serious. So that's why I would kind of just focus on one or two markets and really try to get a foothold before you expand to the next one and the next one. So I think that's kind of at least what we have done, Paul, and that's what I found that the more successful people do, the people that own a deal in Mississippi and a deal in Texas and a deal in Idaho and a deal in Missouri, it's really hard to manage a little 60 unit deal all across and get different management companies and broker relationships, et cetera. So I think a little bit of concentration in a market before you go to the next one and the next one makes a lot of sense to me.
Yeah, one of the things that we see is a lot of people that don't have the experience, say, look on LoopNet and they find a property that they like. They download all the forms from the website. They look at the P&L, the profit and loss, and how the seller has been operating this property, on a 60 unit or an 80 unit building. And they say, well, boy, this guy's doing a great job. I mean, this cap rate is like 8.5 or 8%. And you look down and you see that the operating expenses are like $2,200 a door. Tell me a little bit about, if you're first starting out and you see these operating expenses being so low, it pushes that cap rate up so high. It is really not right. Is there? What's your take on that, Michael?
Yeah, that's if this guy runs it like a mom and pop, and he lives on a unit on site, and he's the handyman or leases units, and so he doesn't pay the payroll because he just uses sweat equity or his own time to fix the leaky faucets or turn over units or whatever. That's certainly something that you're not going to do, right? And your lender won't let you underwrite it to, even if you plan on doing it. So you need to have a proper budget in place. So just because they have a really low payroll number doesn't necessarily mean that you're going to operate it that way. So you need to obviously look at this from the way your lender looks at it. So kind of look historical income numbers, and obviously you're gonna project some forward income numbers, and you can improve upon it and do some value adds. So that's certainly kind of, you look at it as is and kind of going. But on the as is, you need to make adjustments for your operating expenses. So, make sure you get a good insurance quote and adjust your taxes up because the tax man is going to come and adjust your property taxes up typically upon a sale. And, you need to make sure you have proper number in for payroll and repairs and maintenance, et cetera. Because if this guy is not booking, a bunch of repairs and maintenance, it doesn't mean that you're not going to have to do that, obviously. And if you don't count for that, you're going to find yourself woefully missing your pro forma.
It's sometimes nuts when we see some of the stuff that comes in from some of these mom and pop owners or even groups that are trying to sell some of these deals that they're just absolutely amazed that these deals cannot be run at $2,200 a door, and you have to convince the buyer that they're not going to be able to run at $2,200 a door or $2,500 a door or $3,000 a door, maybe $4,000. Depending if it's a 2-pipe chiller, maybe $6,000 a door on an annual basis per unit. So make sure you have some great information when you're talking with a property management company in and around that area on what they expect properties to run. There's some great data that comes out, maybe some Marcus Millichap stuff or some CoStar on what they expect for properties of that age in that area to run for expenses. So don't take the seller's word and that's what the real expenses are, or their actual expenses. That's not right. Hey, talking about things that are not right, tell me a little about some problems that you guys got into, that whether it was a parking structure or fire suppression sprinkler systems. This is just a little coaching and counseling with Michael Becker of things that maybe a new buyer doesn't realize until they get in the middle of stuff.
Yeah, I think we were reflecting as we sold week or two ago, sold a property we owned for about 4.5 years, and that property, the end of the story was really good. We had a really good results. We ended up making a really good multiple on the deal, but it was our first property when we were kind of stepping up, Paul, and we got a kind of A- deal. So it was the first property that we bought that had a fire suppression system, so fire sprinklers, and we go do our inspections and don't typically historically never bought one that had fire systems, so we didn't think to have a fire sprinkler company come out and look at the sprinklers. And so it turned out that this system was approaching 20 years old when we bought it, and it had some defects with the way they kind of built it. It wasn't properly insulated, so it would get really kind of cold from time to time in Texas. It would have some of the pipes freeze and cause water damage. So we had to spend a bunch of time and effort kind of going and finding these little spots that didn't have insulation and insulating them and doing things like that. And then it turns out that these sprinkler heads have generally a useful life of 10 years, at least the ones that they built in the late 90s, early 2000s. They only had a useful life for about 10 years. And the fire marshal will come through on an annual basis and inspect your property and green tag or red tag you. And, along the ownership period, we got red tagged and had to go replace $130,000 in sprinklers that we didn't have in our budget. So that certainly didn't feel pretty good and kind of caught us off guard, and we didn't have that set aside. So we had to use cash flow. So we actually lent the partnership a little bit of money and had to repay it through kind of operating cash. So we had the ability to pay for it and front the money, but we had to take the operating cash to get that paid back. So as you're starting in the business, it's you don't know what you don't know. So hiring a good inspector and management company certainly help kind of avoid some of the mistakes. And then as you grow and trade up, if you're getting new things, so we took that kind of lesson on the first building. We didn't make that mistake again. So all the future buildings with sprinkler systems, we make sure we get a qualified professional to inspect out the fire suppression system and make sure we get all the records from the city and the annual inspections, et cetera. And then as we started buying nicer, bigger deals, kind of the wrap style construction, so having a structured parking, so we get a structural engineer, check that out, the parking structure, and then those tend to have elevators. So you get a certified elevator company, check out the elevators to make sure there's not issues with the elevators, because elevators are expensive to operate. And so those are things that if you're buying something that's got a different component, as if you're trading out of the 70s and trying to go to the 2000s, they had just different components. So you need to make sure that you hire a proper person to inspect it, and you have money set aside, and if it's a good order or not in good order. And we learned that lesson the hard way on the first deal, and the end of the story was good and everyone made money. But that was certainly a lesson we learned on that property, Paul.
Yep. And then when you go up the quality chain, you go from a C property to a B property to an A property. You get higher and better technologies, and these garden style properties that are only two stories versus the 3 and 4 stories. You have elevators too, and I know that you guys go and do full inspections on these elevators, just making sure that you don't have any problems. And do you go make sure that you get like a warranty? What other protections can you guys mitigate? Do you have a annual inspection coming from a group that you hire to make sure that it's
so with these, like elevators and fire systems, you tend to have like annual maintenance. So you have like an annual inspection, or the elevators even quarterly typically. So you hire a certified licensed elevator company, and they do inspections, and they give you a bill every quarter or every other quarter for something, right? So it's always something with the hydraulic fluids leaking or this or that. Who knows, right? I mean, there's always a little something. So you just got to stay on top of that. And that's just an expense, right? So if you're buying it, you gotta put that down as a contract expense, because you're gonna have to pay for that every year. And when you're buying these things and you're going from the 70s or 80s to something that has technology that you didn't have in your former properties, got to stop and think and say, okay, that's likely if I have some sort of amenity like an elevator, it's going to cost me something to operate it. So I need to make sure I account for that, because that's not something you would have historically accounted for when you're buying like an 80s deal. So just think through that and make sure usually that's a service contract that the seller has on property. So we're reviewing the service contracts, you kind of see what the seller's paying, and that's probably a pretty good place to start if you're looking for a budgetary line item.
You're out there looking at Class A properties, and A eventually becomes Bs and Bs become Cs. What amenities are you seeing right now on some of these Class A buildings that are just blowing your mind, that tenants have options to use some of this stuff?
I mean, it was got just, fitness centers and dog parks and, resorts, pools and, some of the newest equipment. I see you walk on stuff and sometimes you see something different. So like in the gym, you ever see like the CrossFit where they flip the big giant tires, like kind of the big tractor trailer tires? They have a mechanical tire flip. So it's like half a tire and you got to flip it back and forth. So that's like the newest piece of equipment. I saw that. I thought was kind of cool a few months ago. So you're seeing stuff like that. I think, I haven't seen anything overly new. I mean, some of these places now, like we had an office building a few years ago. We had like a little mini kind of store. You see them like in hotels sometimes, where they have like a little refrigerated area where you can go get drinks or little kind of snacks or sandwiches or something. So you're seeing some of that. That's kind of putting some of these multifamily deals as well, kind of a little like mini market. So you've seen that. That's been the last couple of years. We've seen that as well, Paul. So just everything's kind of bigger, nicer, better, and they kind of evolve a little bit more. But those are some of the more recent things that we've seen. Zen gardens and trying to think what else, like aqua massagers and
I saw that. That's pretty damn wild. Aqua massagers. You lay on this table and this plastic coat goes over you, and they have high pressure hoses that go on your back and give you a little massage, and that's about 3 or 4 minutes later you feel nice and relaxed and ready to take on your day, and it's just a free amenity to some of the tenants on the property. Other things that I've seen,
I saw too, I thought was really cool, like WeWork and Regis and places like that. I saw one apartment building in San Antonio I toured, had a really well executed kind of co-working space that they had some actual offices that locked off and several cubicles. They rented out to the residents of the place. They're actually like permanent spaces. So I thought that was pretty cool. And then with the lockdowns, a lot of the people living in multifamily buildings want to get out of their 600 square foot one bed apartment in the urban core, so they'd all go work in the common areas and have Wi-Fi throughout, having different little seating and common areas for people to work during the day that work from home. That's of utmost importance today, and those are actually some amenities that actually been used and utilized and pretty heavily here in the last 12-15 months.
Yeah, one of the properties I saw last week I thought was interesting, Class A building, and with the advent of COVID and people staying at home, or now people that are leaving to go back to the office, we're starting to see some cold boxes, refrigerators, that when you order Amazon and your food gets delivered, it doesn't want to stay outside your unit or into a package locker all day if it had some ice cream or some milk into it. So now some of these Class A properties have freezer or refrigerator lockers that they deliver. Amazon delivers it directly into a refrigerator, so all your perishables stay nice and cold. Have you seen that at all?
Yep, that's certainly a thing nowadays as well. So not only the Amazon or the different package lockers, they have actually the refrigerated or freezer ones as well. So that's becoming more and more of a thing, and even those are kind of, some of that's going off site. There's a company called Fetch where they actually have a warehouse, and they have the UPS deliver your package, and then they'll send you a message and then deliver that when the resident's home. And so you kind of schedule the delivery when you're actually home. So that's another thing, because there's more and more packages that these package locker systems that we bought tend to now get a little bit more overwhelmed, because the demand's even greater and greater even than what it was 2 or 3 years ago. So it's a perpetual operational problem.
Well, we learned so much when we talked to Michael Becker. He is where the rubber meets the road, and his group over at SPI, they are buying a large apartment transactions, large buildings in these large metropolitan areas, whether it's suburban or urban, in some of these areas of Texas. Again, Michael, talk to us a little bit about what you and your group over at SPI do.
Yeah, so really the focus of our company really is just buying high quality deals. So we've done some advisory transactions, Paul. So typically if you have say, any more now, they've got to be a little bit larger, but $10 million or more in 1031 money, and you want to come to Texas, you don't know anybody. We've done some 1031 work. We call it advisory services.
Can you give me one time that someone did that, and tell me a little bit of a success story on that, because I think that is absolutely amazing, because you guys are pretty much the only one or two people actually do that in this marketplace. And this is really amazing.
I don't know too many people that do this, but we had we talked about one guy from California that sold a fourplex. Now we're in a 200 unit Class A deal a couple trades later. But one of them comes to mind is had a gentleman that had a bunch of smaller properties in the Midwest, sold them, and ended up buying almost a 400 unit deal just outside of Austin with them a year and a half ago. I guess at this point, and deals has absolutely smoked it and killed it, and we're now looking to refinance it and get a bunch of money out already. And we ended up doing another transaction with him, a month or so ago, also in Austin. So really being able to take some older, smaller stuff and higher price markets that maybe they owned for a while, had a lot of equity, and leverage our track record and relationships and ability to get good debt and just trade up and buy bigger, better quality deals in a market that they don't know anyone and would never have access to deals. So that's really what we're able to leverage our track record and relationship to get some of these larger deals. So if anyone has a large 1031, that's kind of really what we specialize in, solving those problems.
It really is amazing because these people that have they're sitting on a lot of equity in some of these older, not landlord friendly areas, and if you live up in the upper Midwest or up in the upper Northeast or even out on the West Coast, and you kind of can figure out, or your tenant can figure out when they're not going to pay you for 12 months because they don't want to pay you for 12 months during non-COVID times, they can certainly do that. Then you got to pay them to get the hell out of your property. Not so much here in Texas. Our phrase that I love is "you don't pay, you don't stay" here in Texas. And so landlord is, I'm not going to say king, but it is certainly more business friendly, landlord friendly environment in Texas. And so Michael, and his team over at SPI, this advisory stuff, if you have $10, $15 million more that you are thinking about, selling a property, before you do that, spend some time with Michael and his team just to kind of understand what some of your options are. If you're thinking about, relocating your money to a place that your money will be loved and your ownership group will be loved, and that's in Texas. Anything more, Michael?
No, yeah, that's it. And then the kind of do more traditional syndication style, Paul, where we just raise $100,000 minimums and up, and go put large quality, high quality transactions together, and that's kind of really the two things that we do. And again, very, very bullish about kind of Texas and kind of historically what we've done. And I think the next handful of years at minimum have really, really bright future ahead of us. So I think it's a great time to continue to grow and expand.
That's great. So again, Michael Becker, he answers the questions that you and I ask. So we do appreciate his help. Again, I'm Paul Peebles with Old Capital. Have a great day.